This is how money should flow in your business. And if you give me the next 20 minutes, I'll show you a complete system that makes you more money with less volatility and gives you a real way to manage the finances in your business. We currently manage a 9-figure portfolio of companies. And on this channel, we teach you exactly how to manage the financial side of your business. So with that said, it all starts with understanding your income statements. Every business fundamentally starts with some type of cash inflow. And we're going to take the simplest form of cash inflow and we're going to talk about revenue. I've broken this down in great detail in terms of setting this up as a bookkeeping system. And I'm going to add a card right here where you can go and look at that. So we're going to start at the top, and this is where a business gets cash inflow. And it can be from investments, it can be from lending, it can be from revenue. And we're going to assume that it's from revenue. And if you haven't seen my bookkeeping video on how to develop a bookkeeping system for your company, the way that we like to look at things across over 30 different businesses, I strongly suggest you check it out right here. Now, let's look at revenue. Whenever we get revenue, you immediately have to pay for things. And typically you have to pay for things before you achieve that revenue. But let's assume you're already in a cycle of business, you're generating some inventory, and there are just direct costs of goods that come together when it comes to building your product that you're going to sell for money. When we think about direct COGS, right? Direct costs of goods, what does it cost to create it, right? Is the raw materials, manufacturing, product costs? That's what we're going to subtract immediately from that revenue. If our gross profit can do at least 50% after subtracting our direct COGS, this is a good sign in the business. It shows that the business and the product can exist profitably. If you can't pass this check, there's a serious problem in the business model. So we typically want to see at least a 50% margin in direct COGS, but obviously as businesses scale and economies of scale become more prevalent, that can change. The reality is, I don't know a business that can survive on such low margins. It needs to be in that 50% range. When we get to our gross profit check and we're good, we go into direct labor. And when we go into direct labor, we're going to ask ourselves, what does it actually cost in terms of human capacity and utilization to fulfill on the product or service, to actually finish doing the project so that we can check it off in our accounting and say, okay, we've completed this product or transaction, and contractually we're no longer obligated for anything that comes after it, right? The risk has been passed on. And that's basically how we get to a figure called contribution margin. And contribution margin is simply revenue minus direct cost of goods. And contribution margin is simply revenue minus direct cost of goods minus direct labor. We're trying to understand if we can deliver this profitably with humans, maybe without humans, whatever it is. We want a good positive contribution margin, and we target 30% most of the time, and you'll understand why later on. A key insight before we get into it is your gross profit and contribution margin are the true unit economics of your business. It's the fastest way to get a snapshot of what's actually going on. If it's broken, you shouldn't spend a dollar on marketing or advertising because it's going to accelerate the death of your business. There are certain tweaks that you still have to do in the model for it to work. But if it does work, there's a certain cost to acquire a customer, and you're going to choose different marketing channels or advertising channels to get that customer. You're going to invest in a sales team. And the total aggregate cost of that type of activity is called your cost to acquire a customer. Because if you divide it by the amount of customers you get, that's the cost. It's in every single business. Every single business has this. And then once we understand what that number is, we can compare the percentage of CAC to our revenue and come up with a reward to risk ratio where it's contribution margin to risk, the amount of money we have to invest in marketing our product to the market. Is it profitable growth or is it just expensive? If it's broken, you might have a marketing or sales problem if you already know that your product unit economics makes sense, right? Or there's maybe just no product market fit, and that means your business is dead again. But we typically want to see at least a 3-to-1 ratio already at this point. And eventually you have overhead, and that's when you start to subtract your overhead and you have to subtract your taxes. And by the way, this is also the priority of who you're paying when. It's super important for you to invest in your marketing before you pay rent, insurance, software, admin. Now, this isn't personal financial advice, but if you want your business to stay around, you need people in the door, you need people staying in the business. So it's pretty good to invest in that because your customer is your number one priority. You're in the service of other people at all times. And then what we like to do is we like to target a 10% margin because we want to make sure sure that there's no waste that's going to be spent on taxes going to the government. And essentially what you have right here is a complete snapshot of the money flow, the bloodstream of your business. This is super important to understand. This is how you should set up your chart of accounts. Then we go into managing seasonality. And this is when you start to think in a more medium to long-term approach, depending on the size of your business. So essentially, we want to look at our historical data, assuming you've been in business long enough. And we want to see which months were we in a surplus and which months were we in a deficit. And we have a flow chart right here, which basically defines, okay, if our revenue curve is high or low, we need to calculate our contribution margin. We need to see if it's below the expenses that we had for margins, and we mark it as a surplus or we don't. And having this type of data, knowing which months we're going to be in a surplus versus which months we're going to be in a deficit is super important for strategic planning, because going forward, you'll know when to save money and when to spend money, or when you're going to need to spend more money, and you're not going to be caught by surprise. So it's super important as part of your financial system to incorporate some seasonality to know when your business is having good months and bad months. And then when you take the average, you can start to understand what the real profitability is of your company. So after we understand the seasonality of the business, we can go more tactical and we can start thinking about runway decision making. Runway is the question of how long can your business survive with no new revenue. This is the ultimate question. Once you break even on runway and your business is cash flow positive, runway isn't as big of an issue, but it can quickly become an issue if you make new investing decisions. And this is the cycle of business. You go in a position where you have a very strong, stable runway, and then you make a big investment decision that could hurt the company or could help scale it. And this is a constant decision-making process, which is why CFOs and fractional CFOs and controllers stay in business. It's because they need to help manage this. And when you're talking about a lot of money, there's a lot of things to manage, and it's not that simple. I'm giving you a flow chart of this stuff so that you can understand the high level perspective of what fractional CFOs do. We provide fractional CFOs. We are fractional CFOs. I work with companies all the time, and this is a conversation that comes up at least once a month with every business that I've been involved with so far. And when we look at our runway, what I like to do is I like to say, okay, well, what are our contribution margin reserves divided by our fixed costs, right? So if we know we have a certain amount of reserves in our treasury and we know what the total amount is of our direct COGS and our direct labor costs, that kind of looks like runway to me. How do we figure out what the ratio is? Well, here we go. If you have only 1 month, you're in the death zone. One bad month of no new sales, you're in a really vulnerable position and it's not going to be good for you. If you have 1 to 2 months, and this is where most businesses operate here out of negligence or just because they can't make enough sales, it's really hard. You're living paycheck to paycheck. It's hard to make payroll. It's very difficult to scale the business. At 3 to 6 months, you're healthy, but you need to still understand that you're not anti-fragile. You're robust. So you don't gain or lose if something bad happens. You want to be anti-fragile where you gain from both ends. If something bad happens, you gain. And if something good happens, you gain. You don't want to be in a situation where it's like this. Ideally, you definitely don't want to be in a situation where you're losing all the time. Anti-fragility comes when you're at that 6 to 12 months of runway. You can survive serious downturns, right? Like if COVID happened, you could survive that. You can invest in new opportunities at discounts, because when the market is down, that's the time when you want to invest. And you can't do that if you don't have the runway necessary to do it. Anything more than 12 months for most $1 to $10 million businesses, you have a very strong fortress. You're recession proof. You have strategic freedom. You can take better risks. You're comfortable. A lot of the systems that we're discussing are probably in place, or you just haven't figured out a way to reinvest the money, or you haven't paid much attention to it. You were so busy focusing on sales that you just ended up having all of it, and more power to you, right? If we dive even deeper, now we're looking at accrual accounting, because the difference between cash accounting and accrual accounting is the following. In cash accounting, you have money that comes in and then money that comes out, and that's it. And your P&L is reflected on that. In accrual accounting, you might book revenue and not recognize it for 3 months, but it's still considered revenue. Let's say it's January, right? And 3 months later, we're in like April or March. Whatever. You still made that revenue in January. And that's the benefit of accrual accounting, because you're going to be able to recognize that revenue over time. Maybe it's because you have a contract that needs to be fulfilled or whatever. Client might have paid here, but you're not allowed to complete the contract until you're in April. By doing this, you can manage your cash flows more appropriately. You can say, okay, well, I'm not going to pay off this major expense all at once. Maybe I'll use credit and I'll start breaking out my payments here. And that's what we're talking about here, right? When we look at accrual accounting, we look at things from a 13-week cash flow perspective, right? And we look at things from even a daily perspective. And what we're trying to understand here is the order of operations of what needs to get paid first and how many days do we have in between in our cash conversion cycle to do that. And this is where inventory, labor, CAC, overhead comes into play, because you got to spend your money first. Then maybe on day 30, you have to deliver the product or service. Does your contribution margin actually make up what you need to pay in payroll today? Yes or no? If it's an immediate collection, then you have working capital. But if it's not, now you might have a cash crisis that you need to finance, and your 40% margin is trapped because it's still in accounts receivables. So by stretching things out, you're going to be able to forecast what you need to be prepared for so that it doesn't hit you 5 days in advance. If you know that you're missing your margin, maybe you're going to cut expenses earlier on because you know you need to bridge that gap. Your contribution margin on paper on this snapshot right here might be good, but in reality, there's a mismatch in the cash flows of your business. And if you don't have the runway to sustain that type of financing, the liquidity to do it, you're going to be in trouble. Now, naturally, if you send an invoice and you have net 30 terms and the customer pays 30 days later and you receive the money within, 5 to 7 days after that, phenomenal, great job. But we really care about the situations where it doesn't go as planned. And this is why it's so important to start switching to accrual accounting if it makes sense for your business, because you're going to be able to manage the cash flow of the business appropriately. And this is where order of cash flow really happens. And we break this down even further, because the more sophisticated your contribution margin is, the more you can plan out the timeline of expenses from priority to least priority, from highest priority to lowest priority, the better it's going to be. Revenue happens on the customer's timeline, not on your timeline. You can force a sale and you can bang the doors all you want, but at the end of the day, if the customer hasn't sent the wire, you're not going to be that successful. You need to wait for the customer to send the wire. And in the meantime, you got to suffer and you got to pay for all these things in between and take all that risk. And this is what happens when the business operation begins. You're paying your suppliers. There's variable costs that are paid up front. Then you have to pay your team weekly or bi-weekly or monthly. And then you have to run your payroll regardless of whether you made revenue or not. Then you have to pay rent, insurance, maybe software costs, maybe fixed costs that are paid monthly. And then you also have to keep investing in marketing and advertising all at once. And this is all before you collect revenue. So let's say you collect revenue, okay? All right, the customer pays, revenue's collected, your contribution margin gets realized. So what was theoretical and, on a piece of paper actualizes, and you're good. And you have cash flow for the next cycle. Maybe you made a profit. But if it doesn't happen, you have to understand that if this doesn't happen, you have a cash outflow that's incomplete and you have revenue that's still outstanding and your bank account is draining. So even though your contribution margin percentage looks healthy on paper, there's a timing mismatch. So it's super important to think about your timing. You got to think about your timing here. You got to think about your timing here. And that also corresponds to how much you're going to pay yourself, because you do need to pay for all of the managing owner compensation. Let's assume your business isn't a startup. You've been profitable. You've been in business for more than 2 years. This is where things start to get spicy, because I'm going to completely change the way you look at business completely. You need to pay yourself first. You need to allocate some percentage. Maybe if you're making $1 million a year in revenue and you want to pay yourself a certain type of salary, $10,000 a month, you need to allocate a certain percentage of your revenue as a management compensation package. You need to give yourself that compensation package, because that will allow you to have the comfort to make capital allocation decisions that are good for the company without risking the farm. And if that means living on $3,000 a month, then do it. Whatever it is, pay yourself something, not to mention the S Corp election and all the other good things that come from it, but you got to pay yourself something, right? And we also allocate a certain amount of profit. So not only are we looking at contribution margin, but we're also taking a piece of revenue and we're saying we're going to pay ourselves, we're going to put a certain amount of profit, and we're going to figure out also our tax situation. So immediately off the top, we're paying 30% of that. If this is a functioning business with a proven offer, we're taking at least 30%, sometimes even more. And we're immediately putting that into our reserve accounts. There's other types of treasury management accounts that we set up to ensure that we're able to do this. But in essence, you're paying the government immediately, you're paying yourself immediately, and then you're paying the company immediately. And then everything else that you do in terms of unit economics stems from that. These allocations need to happen before the operating expenses kick in. So when you're budgeting and when you're planning, you need to set this up first. Let's see what happens after we make these allocations. Now we know that our cost of goods is protected. We know that we can pay for it based on a certain amount of revenue. So we're already profitable and we can pay for our cost of goods and our gross profits protected. And then we can also pay for our direct labor, which protects our contribution margin. And then we can also finance the company's growth. At this stage, once we're already doing this type of strategy, we are trying to stabilize the business's cash flows. We're trying to make it a cash cow. We're not trying to go for crazy growth. At this point in the business, we're stabilizing. We're basically saying we're going to make our investing decisions off of what's left, not we're going to take what's left. And that creates an abundance mindset and allows you to think about your business more like an asset class than anything else. It allows you to operate within certain predefined constraints that you've created. In the event that you don't have these tax reserves or you don't start allocating this way, you're risking a lot more uncertainty. You're risking a drop in your contribution margin to CAC ratio. Maybe you drop below a month of reserves. Maybe your gross profit margins start compressing. Maybe your cash conversion cycle starts extending, all because you didn't set up your business in a way where you're already paying yourself first a good chunk of the revenue before you have to pay other people. And it's so important to think like that. How do you structure your business in a way where no matter what, the first dollar that comes in, you're getting a piece of that no matter what? That's how you solve this problem. So all in all, when it comes to thinking about the money flow of your business, let's reverse engineer how we can do this where you get paid immediately. Now, this is for business owners who are doing at least $500,000 a year in revenue because of the degree of financial management that'll come into play. But typically, we work with companies that are doing about $1 to $10 million in revenue. So if any of what I just mentioned resonates with you and you'd like to learn more, click on the link in the description below, and I'll see you in the next video.